The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone. Welcome to the Wilkin and Guttentown webinar today on the recent Supreme Court case, South Dakota v. Wayfair. What does this mean for your business? We're going to spend the next hour talking about some of the practical implications of this Supreme Court case. Today's panel, we're going to have three people speaking. A primary speaker will be Len Nitty. Len is a partner with the firm who heads up our state and local tax practice. He's a partner, has been with the firm for 20 years. Assisting him is going to be Meg Newby. Meg is a supervisor in our firm, in our tax department. She spends a large amount of time working on state and local issues as well with Len. She's been with us for about 7 years. And my name is Vinay Navani. I'm a partner in the firm. I work on a lot of international and technology-based clients, and I'll be chiming in from here to there during today's webinar. Some housekeeping points. I know many of you are CPAs looking for CPE, so you know the drill. It's important that you answer the polling questions so that you can get CPE. So please be sure to pay attention to that.
There's also applies for CLE as well.
CLE, thank you, Len. And we will have a evaluation available after the presentation. It's important for us to get your feedback, so please do that. And we will be putting a link up to this webinar on our website. You see the address there after the presentation. So with that, I'm going to turn over the agenda to Len to get us started on this important development.
Great, thank you, Vinay. So this was certainly a very significant ruling in the realm of state and local taxation. Certainly probably the most significant ruling we had in the last 25 years, if not longer, maybe going all the way back 40 years to National Bellis Hess. But we're going to go through today and just a quick snapshot of what we're going to talk about. I'm going to give some background. Why is this important? How did we get here? I'm going to go specifically into, South Dakota and Wayfair. I think that's why you're all listening today. Meg is going to talk about economic nexus and defining that for you and talking about some of the states that have already adopted economic nexus. She's also going to talk about some other remote seller nexus standards that have been trending over the last few years. I'm going to have a discussion on how this may impact income tax nexus. We're going to talk about which businesses are specifically going to be impacted by this, or what types of businesses, I should say. Vinay is going to cover the technology industry, software companies and cloud computing and the like. And then we'll finish up discussing, what's next, what's likely to happen next, what are the states going to do next in this realm, and what's it going to mean for taxpayers to comply with, what has now been likely created by this ruling. So to start with some background, one of the biggest challenges for states is, especially with the rise of internet and remote sellers, is the collection of sales and use tax. Quick example, if you go to your local store, you buy something that's a taxable product, they're going to collect tax from you and they're going to remit it to the state. When you go online and you make an internet purchase, that retailer may or may not be required to collect tax from you based on whether or not they have what's known as Nexus. And Nexus is essentially having a minimum connection to a state that's going to require you to comply with the state's tax laws. So, many purchasers assume that if the internet retailer is not collecting sales tax from them, the sale is exempt from sales tax or sales tax isn't due. That's not entirely true, because if you buy a taxable good or service, tax is still due. If it's not collected at the source of sales tax, it becomes use tax. And use tax essentially mirrors sales tax, and it's up to the taxpayer to self-assess and turn that money over to the state. But Vinay, as practical experience, how many taxpayers do you think comply with use tax reporting obligations?
So if we're talking about individuals, not businesses, I can probably count the number of use tax compliances I've seen on one hand over my career. So businesses are a different story, but individuals, there's a very low compliance rate.
Yeah, agreed. Very rare for an individual to turn over use tax to the state. Businesses are a little better, the more sophisticated businesses certainly.
Because the states are very aggressive in auditing
Yep.
businesses for use tax.
Absolutely, and the next example is when states come in and do a state and local audit of your business. They'll spend maybe a few hours looking at the physical corporate return or partnership return. Maybe they'll spend a half a day looking at the payroll records, making sure you're complying with payroll, and then they'll turn for a number of days to just looking at sales and use tax issues. And they know that it's a gold mine because there's a lot of companies that still aren't in compliance with use tax, and it tends to bring very large payments to the state, and it's very lucrative to them. The challenge is that you don't have enough people or time to make sure that every business in the state is complying, or every individual for that matter. They don't have enough physical auditors there. They don't have that level of sophistication yet to be able to capture these people and know when there is going to be use tax compliance that they're foregoing or not participating in. So what states have been trying to do is they've been trying to creatively and aggressively write new laws and regulations to try to shift the burden to the out-of-state sellers that otherwise haven't had Nexus over the years. And we're going to start talking about some of those now. I think a lot of this got started with mail order companies a number of years ago. And the first two cases we're going to talk about deal with mail order companies specifically, where they were always the out-of-state or remote seller that was selling into a state without creating Nexus, since they did not have any sort of physical presence. So the first case we're going to talk about is National Bellis Hess versus Department of Revenue of Illinois. This is a 1967 Supreme Court ruling, and National Bellis Hess was a mail order company located in Missouri. They had no property, employees, agents, or any other contact with Illinois outside of sending catalogs and occasional flyers into Illinois via common carrier. They did not do any direct advertising in Illinois. No radio, no billboards, no newspaper ads in Illinois. So their connection to Illinois is very minimal. What Illinois did was they amended the definition of a retailer in their tax law to try to capture mail order companies. And they amended it to state that the definition of retailer is going to include engaging in soliciting orders from users by means of catalogs or other methods of advertising. So they felt they captured all these companies, and National Bellis Hess sued them over this. And the Supreme Court of Illinois, determined that Illinois had a valid law, and National Bellis Hess took it up another level to the Supreme Court, and the Supreme Court decided to hear the case, and it ended up being a case that was focused on the Commerce Clause and due process. That's what National Bellis Hess sued Illinois over, and ultimately the court ruled that it held that the Commerce Clause prevents a state from being required to collect tax where the seller's only connection to the state is by common carrier or mail. And what the Commerce Clause essentially tells us is that it authorizes Congress to regulate commerce among the different states, and it's interpreted to include both the authority to regulate, but also an implied prohibition of state laws that discriminate against interstate commerce. The latter of the two, which is the implied interpretation, is what's known as a dormant commerce clause. And that's essentially what the Supreme Court held here, is that Illinois was in violation of the Commerce Clause. Next case, as I said, the states always try to get a little creative and a little more aggressive as some time passes. And North Dakota initiated a new law, which was also aimed towards capturing mail order companies. And in this one, it was a Quill Corp who took North Dakota to court. Quill Corp sold office equipment and supplies. They solicited their sales via catalogs, flyers, advertisements, and telephone calls. So they even exceeded how National Bell's Hess was selling into the state, because they were also advertising, they were making phone calls in addition to the catalogs and flyers. Quill maintained, just like Bellis Hess, no property, no employees or agents in North Dakota. And just like Illinois did, North Dakota amended the retailer definition, and they amended it to include every person who engages in regular or systematic solicitation of consumer market in the state. The regular or systematic solicitation was defined to mean 3 or more advertisements in a 12-month period. So North Dakota tried to set a bright line test for determining Nexus based on this 3 or more advertisements per year in the state. Interestingly, North Dakota lower courts ruled in favor of Quill, stating that National Bellis Hess was applicable here, and the state court did not have the right to overturn National Bellis Hess. The North Dakota Supreme Court heard the case and declined to follow National Bellis Hess, citing it as obsolete, and ruled in favor of North Dakota. And then the U.S. Supreme Court decided to hear the case and essentially upholds National Bellis Hess, citing that a physical presence bright line test is appropriate for determining sales and use tax nexus. And partly in considering this, the Supreme Court considered the due process clause, which has been interpreted by the Supreme Court for sales and for state tax purposes, to prohibit states from taxing a business unless there was a minimal connection between the company and the state. And the Supreme Court felt that the minimum connection would be a physical presence in this case. And this was very significant, and we've done a lot of tax planning, and a lot of professionals have done a lot of tax planning for sales tax purposes, trying to avoid a physical presence so that a business doesn't have to comply with every single jurisdiction that they're selling into. And this has been critical over the years and really has eliminated a lot of the compliance burden that a lot of taxpayers would otherwise be subject to based on this physical presence bright line test.
And Len, let me just make a kind of an editorial comment for maybe some of our younger listeners, and I'll let you define younger however you'd like. For National Bellis Hess and Quill, this is long before the internet, long before you could order anything you wanted on a whim from your phone. At this point, the economy is still largely a retail economy. Mail order is not the majority of how commerce is being done at this point. It's just to kind of set that stage.
Yep, you're right. Quill was a 1992 case. I don't believe the internet was invented at that point. Yep. If it was in a very early stage, right, where I know I certainly wasn't using the internet back in 1992. So that brings us to South Dakota versus Wayfair. And this is a case that was just ruled upon by the Supreme Court last week. And essentially, as we said, states have been trying to find new and different ways to assert nexus against taxpayers. And South Dakota enacted economic nexus legislation for sales and use tax purposes. And essentially what economic nexus means, if you're going to be selling into their marketplace and taking advantage of their economy, they're going to look to subject you to sales and use tax. And Meg is going to get into this a little more in a few slides. But just start there with a basic definition of economic nexus. So what South Dakota did is they enacted this legislation, and they identified 4 major online retailers and notified them of their obligation to collect and remit sales tax under this new law. These 4 retailers were Wayfair, Overstock.com, Newegg, and Systemax. Of the 4, Systemax is the only one that agreed to comply willingly with the law. The other 3 all decided to not comply based on Quill and National Bellis Hess, stating that South Dakota wasn't able to assert nexus here because there was no physical presence for any of these companies. South Dakota turned around and sued these 3 companies to try to force them to collect sales and use tax. And interestingly enough, both the lower and Supreme Courts in South Dakota ruled in favor of the taxpayers based on Quill, and that they did not have the authority to overturn Quill. South Dakota took it to the next level and appealed to the U.S. Supreme Court, and the U.S. Supreme Court granted a writ of certiorari and decided to hear the case. And what was very interesting in this case, compared to the earlier cases of Quill and National Bell's Hess, is in both of those instances, the Supreme Court felt that Congress had to act in order to change the Commerce Clause and its interpretation of it, and that Congress and Congress alone could regulate the interstate commerce by writing new laws. The U.S. Supreme Court here decided that the physical presence rule of Quill was incorrect, and in determining that, they overturned the rulings in both Quill v. North Dakota and National Bell's Hess versus the Department of Illinois. The one thing that the court did not do, it did not opine specifically on the constitutionality of South Dakota's economic nexus statute. It remanded this back to the South Dakota courts to hear and determine for themselves. And I think it's widely expected, Vinay, that we're likely going to have the South Dakota statute upheld by the courts in South Dakota.
Right, because the South Dakota courts pointed to Quill as to why they thought it was unconstitutional. So if the Supreme Court has overturned their holdings in Quill, that would potentially give the green light to the South Dakota courts to uphold that South Dakota statute.
So that brings us to our first polling question. And again, it's important to answer these if you're looking to attain CPE or CLE credit. First one's a pretty simple one, just your basic feel of what you heard so far. How do you think the Wayfair ruling will impact your business? Is it going to impact it A, positively, B, negatively? C, are you unsure? Or do you think this is completely inapplicable to your business or your clients, for that matter, if you're a professional listening?
And so far we have about 70% of the vote. We're just going to hold it open for a few more seconds to conclude. And why don't we go ahead and close the poll? And out of the respondents, 31% said that it was going to be a negative impact. Only 4% said it was going to be positive, and 42% were unsure, and 23% said not applicable. So of those that had a feeling, it's negative.
Very good. So we're going to turn it over to Meg to discuss economic nexus.
Thanks, Len. Despite being in stark contrast to Quill, the former law of the land with regards to sales tax, economic nexus is not an idea that has emerged overnight since the Wayfair ruling and has actually been on the horizon for many years for many states. Economic nexus, which does not require physical presence in a state, instead creates a bright line test for tax obligations by establishing sales and volume thresholds. For sales tax purposes, remote sellers are required to collect and remit once they hit either a certain dollar threshold or a number of sales transactions in either a calendar year or a rolling 12-month period. South Dakota, whose economic nexus standard is now in the limelight, requires out-of-state sellers to collect and remit sales tax once they achieve either $100,000 of in-state annual sales or 200 separate in-state sale transactions during the year. Although the sales component may seem reasonable enough, it's important to note that volume does not take into account the per transaction cost. What I mean by this is, for a company selling $5 widgets, 200 transactions may only result in $1,000 of in-state sales, which is far less substantial than the $100,000 sales threshold in effect. Since Wilkin & Guttenplan services clients primarily in New Jersey and the surrounding tri-state area, we chose to examine the economic nexus standards for those 3 states, as well as the 2 key states of California and Texas. New Jersey is actually one of the few states that has passed legislation regarding economic nexus for sales tax purposes within the past few weeks since the Wayfair case was decided on June 21st. Since this is a recent development, it likely comes as no surprise that New Jersey set the same thresholds as South Dakota. Economic nexus in New Jersey will be effective as of October 1st of this year. Pennsylvania, on the other hand, has no volume threshold and a much lower sales threshold of a mere $10,000. However, it's important to note that Pennsylvania's economic nexus is a notice and reporting law, which allows remote sellers to make an election to either collect and remit sales tax on Pennsylvania sales or to comply with the state's rigorous notice and reporting requirements. The specifics of notice and reporting requirements vary slightly among states, but in general require the remote seller to do the following. 1, they must include a notice on their website that use tax may be due on purchases. 2, they must include a transactional notice with each sale informing customers that use tax may be due. 3, they send an annual notice to customers who spent more than a certain amount, reminding them that they owe the use tax. And last but not least, they send an annual notice to the state reporting information about the sellers who owe the use tax. Needless to say, states have intentionally made this notice and reporting process difficult in order to encourage retailers to back down and opt to collect and remit the sales tax. Although the primary focus of our webinar is sales tax, we did want to mention that a handful of states have an economic nexus standard, which they apply to income tax. California, for instance, requires corporations to file an income tax return if greater than 25% of their total sales are from California customers, or if the corporation had California sales in excess of a certain threshold amount for that particular year. For 2017, the threshold was just shy of $592,000, which has been indexed for inflation since 2011. Another example is New York, which requires corporations to file an income tax return if the corporation has an excess of $1 million of New York sales during the year.
So Meg, let me interrupt you. Up until just now, everything we've been talking about was with respect to sales tax. And while Wayfair was not specifically an income tax case, I think the general feeling is that if physical presence is not required for sales tax, then it's probably not required for income tax either. And that's why you're going to see us in this webinar kind of talk about the two types of taxes side by side, and sometimes we kind of flip in and flip out of them. But they're really two different concepts, and it's just important to keep track. Sometimes we're talking about sales tax, sometimes we're talking about income tax, and what we'll try to be clear when we're talking about those two different things. But the underlying concept of nexus is the same. You have to have nexus for income tax purposes to be subject to income tax in a state, just like sales tax. Sorry, Mike, go ahead.
No, absolutely. Thank you very much, Vinay. So in order to illustrate just how prevalent economic nexus is, we have included each state that has enacted an economic nexus for sales tax purposes. You may notice that of the 24 states that currently have specific economic nexus standards, the majority have the same thresholds as South Dakota. However, it's important to note that there are a handful of states with more lenient thresholds and a few states with stricter thresholds that coincide with the notice and reporting requirements that we just discussed a few minutes ago. Not only that, but the effective dates vary from state to state as well. Like I mentioned on the last slide, New Jersey's economic nexus is effective as of October 1st of this year, while some states have effective dates that predate the Wayfair case. Since each state has a different stance with regards to economic nexus for sales tax purposes, it's important to understand the nuances of the state that your business does not have a physical presence in, but may still have a sufficient enough connection to. Now, even before Quill was overturned and physical presence was no longer a requirement for a state to subject a business's receipts to sales tax, many states had implemented clever standards in order to compel remote sellers to collect and remit. Although a business itself may not have a physical presence in a state, the physical presence of an affiliate of the business or affiliate nexus is sufficient enough to subject the business to sales tax. Click-through nexus enables a state to impose sales tax on a remote seller who contracts with an in-state individual or company who directly or indirectly refers potential customers to the retailer through a link on the contractor's website for either a commission or some other form of consideration which is paid upon the sale. You may have heard of click-through nexus referred to as the Amazon law. Cookie nexus refers to internet cookies, which are small pieces of data sent from a website and stored on a user's computer that record the user's browsing history. For example, when you make an online purchase, Cookies are why you start to see similar products advertised on different websites that you visit after the sale. Remote sellers who install cookies on an in-state user's computer are viewed as having nexus with that particular state. Marketplaces such as Amazon, Etsy, the like, are required to collect and remit sales tax as the retailer in certain states where the marketplace has a physical presence, rather than the requirement being imposed on the individual sellers. Trailing nexus is a method used by some states under which businesses that cease the activities that created nexus with the state in the first place, whether that is economic or otherwise, continue to have a tax obligation after those activities have ended. Trailing nexus periods range from 3 months to 4 years, depending on the state. Use tax notice and reporting requirements were discussed previously, but just as a reminder, are typically elected by a remote seller in lieu of collecting and remitting the sales tax in a state. And with that, we're at another polling question. So polling question number 2. How do you think that states that currently do not have economic nexus standards for sales and use tax will react to the Wayfair decision? A, by implementing the same threshold as South Dakota. B, by implementing a higher, more lenient threshold than South Dakota. C, by implementing a lower, stricter threshold than South Dakota, or are you unsure?
And so far, we're at 70% of the vote in. Let's just keep it open for a few more seconds. Okay, Amanda, why don't we close it? And the results were 68% felt that it would be the same reporting threshold as South Dakota, 20% were unsure. So
I would tend to agree with that, and I think probably all the panelists here would agree with you as well by implementing the same threshold as South Dakota. Like I said before, even New Jersey implemented the exact same standard.
Very good. Thank you for the great information, Meg. So now we're going to talk a little bit about the impact on income taxes and some other types of taxes as well. We already have where several states have enacted economic nexus for income tax purposes. Many in the corporate tax realm, but it's already been happening. Meg said earlier, California is one of them. And typically it'll focus on a certain threshold of sales to create a bright line test. There's also bright line tests for payroll that you could have in a state and property in a state. So oftentimes you're looking at 3 factors, and if any of the factors exceed the bright line, you would have an income tax nexus with that state. One thing that all these states who have enacted income tax nexus thus far has been very careful of is Public Law 86-272. And they've written for the most part into their laws that economic nexus applies unless you have Public Law 86-272 protection. And essentially what Public Law 86-272 tells us is that if your only connection to a state is the solicitation of orders of tangible personal property within that state, and the orders are sent out of state to be approved and fulfilled, that's not sufficient enough of an activity to create income tax nexus. And again, this is just for sellers of tangible personal property. So who this doesn't protect is sellers of services, or somebody that's selling services plus tangible personal property. So that's really what the states are targeting and have targeted so far in terms of economic nexus, knowing that Public 86-272 still exists and is still around, even though it was intended to be a temporary law initially. It has stayed around for a long time and has been great authority for taxpayers who were trying to limit income tax nexus in various states.
Can I just make a comment on 86-272? The protection that a company can get under 86-272 is very narrow. It is limited to those people who are selling tangible property and doing nothing but a pure sales function. I've really only worked with one company in my career that I felt comfortable qualified for that. So something as little as a salesperson picking up a customer check or handling a return or doing a demo takes you out of that protection. So it's a very narrow window.
Yeah, it is a narrow window. I agree with you. I've seen more than one in my day, but you know, it's very easy for you to get tripped up and violate or move past the protection granted without the company even knowing, because of what the salesman may or may not be doing within the state. So even though they're doing everything they need to and want to comply with it, as you said, it's a very low threshold, and it's very easy to exceed that without the intention of that happening being present. So what about franchise taxes and other taxes? As you know, I said initially in the start of the presentation, states have been doing a lot of creative things to get around Nexus rules. And one way that they've tried to get around Public Law 86-272 is to create a tax that's measured on something other than net income, because that's all that Public Law 86-272 protects. So with franchise taxes, Texas is a great example of a franchise tax. Texas taxes taxpayers based on gross sales, less a predefined determined deduction of either 30%, whatever the gross payroll is, or cost of goods sold. So because it's not measuring pure net income in that state, franchise taxes are protected by 86-272, and therefore states have the right to taxpayers that, you know, don't have Public Law 86-272 protection. You know, other states have gross receipts tax, like Ohio and Washington State. You know, Pennsylvania for a long time had a capital stock tax, where they tax a percentage of your net capital. Other states have done that as well. So all states have been historically looking for ways to subject more taxpayers to tax. Franchise and other types of taxes are one way that they've done it. Those types of taxes are completely not impacted by the ruling here, because there was no standard or no protection. Where Quill and National Bell Assess were protecting sales tax, and Public Law 86-272 was protecting income taxes. These other states have gone around it with these creative methods. You know, the next big question that I think is going to be on a lot of people's minds is, will the states now attempt to challenge Public Law 86-272 as irrelevant? You know, Vinay, what do you think the likelihood may be of this?
Yeah, I don't know. I see 86-272 as being so narrow that I don't see a lot of resources being devoted to that issue. But that's just my opinion.
Fair enough. I could certainly see states starting to write laws for economic nexus without including the 86-272 carve out, and whether they would be challenged on that or not, you know, it's unclear. But it's certainly possible that states will now start to take the position that this is outdated and irrelevant based on the ruling in Wayfair, but that's yet to be seen. So what about impacted businesses? You know, I think from Wayfair and Overstock.com and Newegg are, they're internet sellers. We clearly know that internet and remote sellers who are selling taxable products or services are greatly impacted here. And we'll talk at the end a little bit more about what their compliance burdens are going to be and what they may need to do to comply with this, and all these new laws that the states are going to write. You know, service providers have historically, you know, if you've historically been doing work back in your home base and you've just been hired by a company to do it, you've never had a connection to a state. If you sell a taxable service, you're absolutely going to be impacted here. You know, another type of company that I'm going to kick it to Vinay, because he's our international tax guru, is what about international companies? Are they going to be impacted by this?
Yeah, I think they absolutely can be, especially when you talk about the context of a remote seller. You know, just because if you're selling into a state, I don't think there's a distinction between whether you're selling from another state or from another country. The state is going to take the position that sales tax has to be collected, and that foreign seller probably has bank accounts in the U.S., probably has inventory in the U.S. that could be subject to a state lien and levy. Also, if that foreign seller decides to come take a more active, develop a more active footprint in the U.S., they will have this kind of this sword hanging over their head that they're on this state's naughty list. So, you know, I can easily see a situation where a foreign seller is subject to state sales tax, but not subject to federal income tax. It could make all the sense in the world. So it really applies to everybody.
Yeah, I agree. It's potentially a big unknown issue by a lot of international companies. And it'll be interesting to see how the states attempt to find those companies. Yes. This also has a big impact on the technology industry, whether they're sellers of hardware, creators of hardware, software, cloud computing services. I don't want to go into too much detail here because Vinay is going to go more in depth here in just a few minutes. But another industry that's significantly impacted here by this ruling. And I know when we did the initial poll, the majority of the responders that had an opinion on it felt that this was negative impacting businesses. Not all businesses have been negatively impacted by this. The brick and mortar stores, the typical stores you physically go into and buy something in a state, they have always kind of had a competitive disadvantage or a perceived competitive disadvantage because of the sales and use tax collection, where a lot of consumers felt that it was more expensive to physically walk into the store, forgetting about the convenience of being able to buy something same day, because they were going to be subject to sales tax on it. They'd almost rather buy from an internet seller who didn't have Nexus, whether they realized they were still subject to use tax laws remain, who knows, but they weren't complying with it. So these brick and mortar stores have now, leveled the playing field with regards to that perceived competitive disadvantage. I think those types of taxpayers are going to be very happy with this ruling because it will probably encourage more people to come in and save on shipping costs now, knowing that they're going to have to pay sales tax either way in most instances. And, there's a lot of businesses or types of taxpayers that are going to be completely unimpacted here. You could have the real estate industry. Real estate industry, clearly, if you're an owner of real estate, you have Nexus wherever you were, regardless of this ruling, so that you're completely unaffected for the most part. Maybe professional service providers. Most states don't tax professional services, so you don't have to worry about it as much. Most states have, if not all states have, reseller exceptions. So if you're just selling, if you're not selling to the end user, perhaps you don't have an issue here. Outside of now, you probably want to start collecting resale certificates from every vendor you have, not just those in the states that you have Nexus. So, this is very significant for many businesses, but not all businesses. Some businesses will not be impacted by this. So with that, I'm going to turn it back over to you, Vinay, for how this is going to impact the technology industry.
Sure. So we've been talking a lot about e-commerce retailers, but I think the other obvious industry is technology, because technology, almost by definition, is the solutions the technology products provide don't require physical presence. So I want to spend just a minute or two talking about how the Wayfair case may impact technology companies. And we're going to focus on three main types of services: cloud-based services, data processing services, and sales of software. So let's just spend a minute talking about the different types of cloud services. Most products that we think of today in the digital world are software as a service. And these are things that we use every day, constantly throughout the day on our phone or on our computer, Gmail, Dropbox, whatever the services we're using this on this webinar, GoToMeeting. This is the predominant way that technology products are sold in the world today. The next two we're not going to talk much about, but I wanted to raise them because I want you to be aware that if any of these two impact you or your business, states have different rules for this. So one of them is platform as a service. This is something you're going to subscribe to or purchase if you're a developer. Python, a Python platform to write code to develop apps, something that you're going to use to help build a product. Different states have different tax rules for platform as a service. And the other variant is infrastructure as a service. This is where, in lieu of building a server room and buying hardware, you're just buying raw computing power. The biggest example is Amazon Web Services, that you can just simply subscribe to and instantaneously have access to a server. So again, states have different positions on infrastructure as a service. So if this is you, then you need to look at those rules separately. But looking at SaaS, and we're back to our 5 kind of test states for purposes of this webinar: New York, New Jersey, Pennsylvania, Texas, and California. If you see under the subject to sales tax, we have 3 of the states, New York, Pennsylvania, and Texas, are subject to sales tax, whereas California and New Jersey are not. So I'm developing a online application, for any, pick any example you want that requires a monthly fee. It provides some interface to users, and they're interacting with it on their computer, on their phone. If I have customers based in New York, Pennsylvania, or Texas, as I have that monthly charge, I have to collect and remit sales tax, whereas if I have users from California or New Jersey, I don't have to. So this gets to be a tremendously complex aspect of my sale. We're not going to talk too much here about different software solutions, but there are software solutions, and I'm sure they're going to be they're ramping up even more so with the Wayfair decision, that will need to integrate with your online platform to help figure out where is your user and what is the sales tax rate and how do you collect it and how do you remit it for these types of products. The other thing, as Meg alluded to, is these rules are changing literally every day. So anytime you find a list on the internet, you got to make sure that it's up to date, because again, states are reacting very quickly to Wayfair and figuring out how they're going to tax this stuff. So that's the sales tax side. Now, let's also talk about income tax. And I'm going to bring up 2 concepts that are important to understand when you have income tax, which is how do states consider whether that a revenue is sourced to that state or not? Because if I'm selling a SaaS product, I could have a filing obligation in most all of the 50 states, assuming that they all have economic nexus statutes. So how do I figure out what sale is a California sale versus what sale is a New York sale? And there's 2 main concepts. One is market-based sourcing, that says a state will consider a revenue sourced to our state if the customer who's getting the benefit is located in our state. So New York is a state like that. If I'm selling and I have a New York customer, regardless of where my work is being done or where my servers are, that revenue is subject to taxation in New York. Other states look to see where did you do the work, a cost of performance. So Texas is a cost of performance state. New Jersey, until the end of this year, is a cost of performance state. So it would be nice if there was some central coordination among all the states, that they were all either market-based or all cost of performance. But unfortunately, there is no rule. So it's not hard to imagine situations where the same revenue is taxed twice, or revenue is not taxed by either state. So you also need to keep in track of, when you're doing your income tax, how are you sourcing your revenue, and considering that, because that really needs to be, that data is really going to be driven off of your sales tax system when you are actually at the point of sale. So you have to keep that in mind. Data processing services are services where the customer is taking data from other people and manipulating it or connecting it to produce output. So one example is a company, which is a client of ours, which takes information from online travel agencies and connects it to the hotels that have the rooms that they're trying to sell on the online travel agency. So somebody has to be that, this company is that connecting bridge between those 2 companies, because you have to connect a lot of online travel agencies to a lot of hotels and airlines. So that's what this company does, data processing services. And I would say there are fewer, the minority of states subject these types of services to sales tax, but I did mention it here because Texas is a state that taxes that, and it is a common service. So if what you have is not clearly a SaaS product, not clearly a software product, it may be a data processing service. So keep that in mind as you're trying to figure out what kind of product it is you have to determine the sales tax. Software, if we had done this presentation 10 years ago, this would have been the main topic of the presentation. Now the main topic is SaaS, but software is its own category, and there's really two main important aspects. Pre-internet, if you needed to buy a copy of software, you would go to your local Staples store and you would buy it on a CD-ROM and load it into your computer. So states would focus on what was the medium on which the software is delivered. If it's something you can touch, it would be considered tangible personal property and generally subject to sales tax rules. Today, nobody buys software on CD-ROMs. It's all downloaded, and that's the IPP, or intellectual personal property, or intangible personal property, excuse me. And as we're going to see on the next slide, most states will treat that a little bit differently. And that's canned software that's ready to use immediately. Custom software is a different category. Most states will tax that as similar to a professional service. And with some exceptions, most states will not tax custom software. And then you have customization of canned software. So if I'm implementing a large, SAP installation in my firm, the customization may cost just as much as the software itself. So that's another category of software to be considered when you're talking about sales and use tax. So a lot of different variations. As you can see, when it's subject to sales tax, all states will subject canned software delivered on tangible personal property to sales tax. In fact, if there's any tangible personal property involved at all, most states will subject to sales tax. Other states are more aggressive in what they will tax in terms of downloaded software. One observation that you see, Texas is probably taxes the most. Texas is a state that, while they have a corporate franchise tax, they do not have an income tax. So states that don't have income taxes generally will have the more robust sales tax rules and will often subject more things to sales tax than states that don't have a lot of, that have an income tax. So again, different matrix based on exactly what kind of software you're selling. The other thing that, before we get to the polling question, is managed services. Today, it's very common to have your IT network supported by a third-party management company who has access to your system. They can update software. They can fix problems, doing everything remotely. They don't necessarily need to be in your geographic location anymore. And just keep in mind that many states will consider those types of services as maintenance services, which are taxable services. So do keep that in mind when you're talking about digital products. So now we're coming to a polling question. What do you think provides tech companies with the greatest level of uncertainty? Whether their specific product or service is subject to sales tax, do they have Nexus, how to source their receipts for income taxes, or you're not sure, or something else. So we need to move forward with the voting, so please vote as soon as you can. We'll hold it open just for a little bit longer. Okay, Amanda, why don't we close the poll? And the biggest respondent was 40% if they have Nexus, economic, or other in a state. So that is a hot button issue, and it's going to be something we're all focusing on. So with that, I think, Glenn, you're going to talk about some concluding remarks.
Yeah, exactly, Vinay. Thank you. So, what's going to happen next year? And, some of this will be speculation. Some of this will be how it's going to impact businesses throughout the country. The first one's an easy one. Many states are going to pass copycat legislation. States do this all the time. They'll wait for one state to pass an aggressive law and wait to see how that's challenged in court and whether or not the state's successful. This happened when New York challenged Amazon and asserted click-through Nexus, and New York successfully was able to assert click-through Nexus. Many states immediately afterwards, within the next couple of years, started to adopt click-through Nexus standards. Same thing is going to happen here without a doubt. We've already seen that with New Jersey and Wisconsin almost immediately passing economic Nexus laws. I know that's probably what helped New Jersey not to go into a state shutdown, was the revenue created from the economic Nexus law, which I think the state estimated to be $180 million this next fiscal year. That may even be pessimistic. I'm not sure, because there's millions of dollars at risk here for states who don't have the economic nexus laws for sales and use tax. So I think that's a given, and we'll see this happen quickly, fast and furious. So that's going to create a lot of complexity for businesses out there. They're going to have to probably review what states they have nexus in now, and they're going to have to do it on an ongoing basis as states continue to pass these types of laws. The law today may be different from the law tomorrow, and very different from the law tomorrow. Another major challenge is with economic nexus, states are going to have to, businesses are going to have to start to look at states specifically and whether or not they tax their product or services. There's no uniformity across the country. A lot of things are similar in nature and what they tax and what they don't tax, but it's going to be a big compliance burden to go through for these businesses and figure out, one, which states do I now have nexus in, two, do I actually have to collect tax based on the product or service that I'm selling into that state. Part of the complexity is the number of jurisdictions that will assess sales tax on you. If you're dealing with a state like New Jersey, where we're physically sitting in right now, it's not too bad. New Jersey just has a flat sales tax rate on everybody in the state at one number, so there's not a lot of thought that has to go into it once you figure out if your product or service is subject to sales tax. Unfortunately, many states like New York, Missouri, Colorado, Texas, they also have local sales and use tax, and that creates a lot of complexity. I think I believe there are over 12,000 taxing jurisdictions in the U.S. from a sales and local use tax purpose. That's enormous. That's a huge compliance burden for these companies to try to start figuring out, especially for a New Jersey company, trying to figure out how many different tax rates do you have to collect for Missouri customers. They're just not used to it. So how do you go about dealing with this? I guess businesses have a few different options at their disposal. First one wouldn't be recommended by us, but they may stick their head in the sand and just ignore the problem until a state comes and finds them.
Definitely not recommended by us.
Definitely not recommended, but that's going to happen. A lot of businesses will take this approach. Number two, they could hire additional staff to try to comply with this, because this may be a full-time job for a business just trying to deal with sales and use tax compliance. Another option is to find a software solution. Right now, the better software solutions, the high-end software packages, are very expensive to not only purchase, but also to install and integrate into your accounting software and your sales software. So, it's going to be a huge cost and complexity to a lot of business owners, and this is. One of the things that the court thought about when they had ruled in favor of Quill many years ago was the burden of trying to comply with all these different laws. And at the time, it was only a little over 6,000 different jurisdictions that was subject to sales and use tax. Now we're double that. So hopefully the software will help with that, but it's not an inexpensive process. What'll be interesting to figure out now, or to see what happens, and Vinay kind of alluded to this, is will we have new players in this marketplace now? Yeah. Will Amazon or Google jump in and try to find a more cost-effective solution, not only for those that are selling through the Amazon marketplace perhaps, but for any business to be able to have a subscription to? That type of a solution may be fantastic.
I think that's got to happen.
Yeah.
And even as we speak, I see emails all the time from new companies or existing companies that are talking about their integration with various online shopping platforms. So I'm optimistic that there will be a affordable technology solution, because that's really the only realistic way I see to make this work.
Yeah, I agree. Hopefully we get that, and I think with this ruling, there'll be enough businesses that need this type of product now that somebody is going to jump on it and develop it. How quickly that happens is another story, but hopefully we don't see that in the too distant future, because that would really be of great help to taxpayers. And one thing that I mentioned earlier, I just want to reiterate here is, as you're starting to deal with your sales tax compliance, one thing that a business selling to resellers predominantly is going to want to start doing is now updating their files and making sure that you have resale certificates from every one of your clients that qualify. And another challenge is some states require that you physically register with them for sales and use tax purposes just to be able to accept a resale certificate. Without those resale certificates, if you have a state come in, they're going to look to assert tax on you even if it wasn't a taxable sale. I had a big issue with that in a recent Texas audit, and we were eventually able to wiggle out of it. But the fact that the seller didn't, or the purchaser didn't issue a properly completed resale certificate was a major issue, and you want to try to avoid that headache. So next one is one that I really hope doesn't happen, but we'll have to see what the states decide to do, is whether or not they're going to try to impose retroactive compliance under economic nexus, where the business has already made the sales to their customers, has not collected sales tax based on Quill and National Bellows Hess. Maybe some of these states had already had economic nexus laws in place, and the businesses were kind of waiting to see what happened in the Wayfair ruling and other challenges that are happening throughout the country. But if states start to impose retroactive compliance, that's going to create a major burden on businesses, because they're either going to have to dig into their own pockets to pay it, or they're going to have to start to try to chase down their customers to collect the sales tax after the fact, which isn't an easy thing to do. And what happens if you see this is a major problem for you, and perhaps you're operating in some of these states that have economic nexus laws already, and you've opted not to comply with them, you may want to consider tax amnesty. If the states offer a tax amnesty program, many probably will as part of this, or if they offer voluntary disclosure agreements or programs, you may want to consider entering into one of those to limit the interest and penalties that you could be assessed upon audit. So with that said, I think we're right up against the 1 o'clock finish. I don't know if you want to try to sneak in a question, Vinay?
Yeah, our last polling question?
Last polling question, yes. Sorry. Got to make sure that everybody gets their credits.
Do you expect to have sales tax nexus in additional states due to economic nexus? Yes, no, unsure, not applicable. And I think we're, let's go ahead and close the polling now. And most people have responded yes. They do expect to have additional nexus due to this decision.
Yeah, I think that's clearly going to happen.
Yeah.
Unless you're just a brick and mortar type of establishment.
Right. I think with that, that takes us to the end of the webinar. We hope it was informative. We probably were talking about more questions than answers, but part of the challenge with this is that every situation is very fact specific. So it's hard to give general advice about what to do in your business. It's really something we need to look at. Every business has to look at their situation uniquely to see what's the best method of approach and compliance for their specific business. So we're happy to discuss these specific situations with you. Our contact information is on the screen above, and we hope you enjoyed this, and we look forward to seeing you on another Wilkin and Guttenplan webinar. Thank you.